we're going to go ahead and at least start off with some introductions, and then we'll follow it up afterwards because we've got everyone that was in the waiting room already right now that has been signed in. So looking forward to it. I want to say hi to everyone. Just let them know that, first of all, I'm David Millsap, so market leader here at Movement. And we are so excited we've been waiting on this COVID thing. I got some of you that have pictures up, some of you that don't. That's fine and good. I put my makeup on this morning just to be ready for everyone. But we wanted to say welcome to you and to let you know that we have a series that we're doing. We were kind of waiting because we like to get together. A lot of you know us, know that we like to get together out with our realtor partners and be shoulder to shoulder and really figuring out what all's going on and what we can do to help you and your clients win more. And this is just, it's a crazy time right now. So we know that things are different than they were, but we're just waiting on this. When this ends, we're not going to wait on that anymore. We want to get out there and do what we can to build value with you, our realtors. And one of the ways we're doing this is a 3-part series right now. Next Tuesday, we will be doing, today is Ask the Underwriter. Next Tuesday, we'll be doing same time, and you'll get an invite on this as well, Ask the Appraiser, where we will have the senior VP. He actually runs our appraisal management company called Karis. But Colin will be on with us next Tuesday, this same time frame via Zoom. So you can ask the appraiser. I know there's a lot of questions regarding appraisals and everything going on right now. What's the community seeing from this area to that? So we'll do that. And then our third part of the series will be Ask the Credit Expert, which will be Jordan Goldberg. And he's our representative with Credit Plus, who is who we use to pull all of the credit bureaus that we have. So we'll have a 3-part series. Today's the first, Ask the Underwriter. We're looking forward to diving in. I want to kind of give you a little bit of what we're wanting to do this morning. First of all, I'm really happy. And with all the volume that's out there, purchase and refi right now is crazy. We know that. We focus on the purchase side. But I'm excited the fact that we've taken an hour out of their day, and they're okay with that, to be able to share and answer your questions. We have Tracy Weesey on here, who is our community leader, and we can tell you more about that. Ask your underwriter your loan officer what that means with here at Movement, because I want to spend a lot of time on that. But it's really a key factor of how Movement is able to move things through faster than most people can. We also have Mark Forster on here, who is our underwriting manager for our community here. They're all down here in our Fort Mill, Indian office. One of our corporate headquarters, actually the corporate headquarters of 3 operations centers throughout the country. So with that being said, I'm going to dive into the fact that Tracy Weesey, again, is our community leader. And all the years I've been in the business, I can say in front of her and everyone else, I can't think of anyone I've enjoyed working more with from the sales and operations side as Tracy. She's just, her work ethic, her knowledge, and her patience with us in the field is beyond anyone I've ever worked with. So, so glad to have her. And Mark Forster is a walking encyclopedia when it comes to guidelines. And we're really blessed to have him on our team as our underwriting manager as well. So there's the intro. Our format is really going to be this, not a lunch and learn or a breakfast and learn or whatever. This really is all about you asking questions. So you can either do so in the chat box. I know some of you have done a lot of Zoom. Zoom, I know, is literally a 4-letter word, but it's also a 4-letter word. I know in a lot of people's minds too. I know people are getting tired of hearing the Zoom thing, but that's where we are today, to be able to get to have these kind of events. So if you want to pop a message in the chat box, and I'll try to monitor those and go through as we can. But we really want you to ask some questions, and we want to have Tracy and Mark answer those so that you can kind of relieve some of the frustration I know that's out there with all the COVID stuff and all the other changes that have been going on in the past year. Now, that being said, I did want to ask Tracy to kind of give you an overview of kind of the market and COVID. A lot of you have heard about COVID overlays and things like that. Just to kind of preface that, and then we're literally going to jump into some Q&A from you all, and we'll run with that. So Tracy, do you want to kind of share a little bit about overall our goal from an underwriting standpoint and things like that, just starting off?
Sure. Well, good morning, everyone. It's a pleasure to be here with you. So Movement's philosophy has always been that we underwrite strictly to agency guidelines. We do not have overlays unless the agencies impose overlays on us. So currently, some of the agencies do have overlays due to COVID. So we know for conventional Fannie Freddie, any self-employed borrower, we have to provide a year-to-date P&L. If it's unaudited P&L, then 3 months bank statements will be required to support the income on the P&L. And if it doesn't, additional information may be required. If the borrower provides us with an audited P&L, then we do not require the bank statements. But that is strictly from agency. That is not a movement overlay at all. And also we have very few FICO overlays. And again, those are strictly agency overlays. Most all of them have already been lifted. And this is a huge benefit because we know that there's a lot of banks and other competitors out there that are still imposing their own overlays, but Movement is only adhering to the agency overlays. So that's a huge plus for you. So that's a big benefit, but it's always been our underwriting philosophy that we're going to underwrite to agency guidelines, to DU and LP. We train our operations staff not to add a lot of warm and fuzzy type conditions. So we only ask for what we absolutely need to have. So that's really good news for you and for your borrowers.
All right. So thanks, Tracy. Someone had to let someone else in on our waiting room. So good for that. Thank you for that. And gang, if we want to, we'll start it off. I know there was an email that we got right before this that I wanted to make sure we start off with answering that, because there was a questions we got with regard to, this is from Vicky. So what's the difference criteria and the process between refinancing and first mortgage? So Vicky, I want to make sure, and by the way, you all, anytime you want to, you can click on the button down there at the bottom left and unmute yourself if you want to. But Vicky was asking about that this morning. I want to make sure you're talking about the difference in the criteria and the process between refinancing and says first mortgage, but are you meaning purchase? Vicky, you on there?
Yes.
Yeah. Okay, so purchase. All right. That's good. Tracy and I were talking about this a little bit before and everything. Really, from a criteria standpoint, there's not really any difference from an underwriting, whether it's purchase or refinance. It's going to be the same underwriting guidelines with regard to that. There is a difference here at Movement with regard to the process, only in the sense of prioritization, really. We have begun, the company was started 11, 12 years ago with the whole premise of purchase is our focus. We are a purchase focused, realtor centric company and have always been and will always be. So if we have refinances that come in, but we've got a purchase that is comes in either before or afterwards, that is going to be prioritization number one for us here at Movement. Just because it is. Now we're still doing refis in 45 days, some of them even less, whereas other places I'm hearing are 60 to 120. But with Movement from a purchase process side, really the only difference is regard to the fact that if we have a purchase closing tomorrow and a refi closing tomorrow, or scheduled to, that purchase has been given priority over that refi and will every time. And I hope you all feel the same way about that as I do, because we want to make sure we take care of our borrowers. Our refi client is important as well, but if they get moved 2 or 3 or 4 days, whatever else, they're still in a house. None of us want the borrower, the buyer of that new home or the sellers sitting there for 2 or 3 days waiting on something. So that's the one difference there. And then the other question was, what document is used to qualify the loan amount in the beginning of each new calendar year when the previous year tax return has not been filed yet. So I'll let Tracy and Mark answer that question.
Okay, so if the borrower has not filed their 2020 tax returns yet, then we're going to go off the previous year's tax returns. So we would be requiring 2018 and 2019 tax returns. And then, of course, we would need to have a P&L for 2020. And then if we get past the first quarter in 2021, we would also need a year-to-date P&L for 2021. And then the corresponding bank statements for conventional financing if it's an unaudited P&L.
Vicki, that help you?
All the agencies are we're requiring P&Ls for conventional and government financing.
Gotcha. Then the other one had on here said, how does a credit card balance, or how will it affect the loan amount and loan approval process? That's a great question. That's one that really actually will be probably asked and answered again with Jordan in 2 weeks on the Credit Plus call. But I will tell you this, as far as the process and loan amount and everything like that, the debt to income ratio, of course, we will look at that on revolving credit card debt. Mark, Tracy, fix anything I'm going to be saying here from the underwriting side. But the biggest aspect with regard to that is we literally have seen customers that have absolutely perfect credit with regard to they're paying bills on time, never missed a late payment, never have had late payment, anything on their credit card at all. The problem is their balance is X and their credit limit is X and their balances are 90, 95% of X, or even 70, 80% of X. 20% of X paid perfectly and 90% of X paid perfectly. The 90% is going to affect the credit score, because what it's saying is, yeah, you're paying on time, but you're paying an awful lot of people every month and maxing out that credit card limit. So a lot of times what we advise our clients is like, keep your credit card balances low. Don't close them, just keep them low so that it doesn't affect your credit score as badly. Either way, we're going to count the debt, whatever that monthly payment is showing on there. But it's a great question and something that I know will come up on our call, I'm sure, in 2 weeks. There was a question here also about land and what's the criteria for land, lot, and purchase, et cetera. How's the different process, one for approval or the other? Movement, we don't do any land. And lot purchases really is going to be best handled by a community bank or one of the land credit farm type agencies that are out there. There's several, 2 or 3 of them, but I would contact your local loan officer, because we want to be a source for you to help align you with the people that are providing the financing that we might not. And the lot loan side of it is really hard to find these days, but it is out there. So Tracy, there's some more messages coming in here, so I'm going to look down at those. Okay. Walk through those. Here's a good question here. How do borrowers with student loans in deferment due to COVID relief, how are they being viewed by the underwriter? I've had potential buyers tell me they can't get on a repayment plan even if they wanted to, because it wasn't allowed due to COVID relief. Tracy, Mark, you want to see that there?
Mark, I'll let you know.
Yeah, it would depend on the program really on this one. I mean, if it's an FHA, we're going to count what their standard 1% would be against them all the time against them. And then we're going to go back and just check their payment history. I mean, as long as it's not reporting as late on the credit report and it's just showing them as deferred or fine. Same thing with conventional, really. It's just a matter of how it's reporting on the credit report. If they're truly reporting them late or moving to the end or just skipping the payments, we're looking for just that balance. Are going to be using the 1% against them instead of what the actual payment is most of the time on this.
That's a big help, because that actually comes up a lot. Bernadine asked kind of a follow-up on that. So what's the rule with FHA borrowers who have high student loan balances? And any way to get around that 1% rule? Can it be done with an amortized student loan payment? And if so, do they have to be making that amortized payment?
I always mix them up, so I'm putting up the guides right now myself. Hold on 1 second.
I love it. While you're doing that too, there's another question from a vet here that says, has there been any talks of new guidance around that calculation of student loans that are in forbearance? 1% versus 0.5% versus normal payment. Have y'all heard anything about that with regard to with COVID guidance?
I have not seen anything come out on that recently.
I have not either.
What I was thinking there. On that, let's see, Mark, you're muted still on that thing. Did you get the thing on that student loan?
I'm having computer technical difficulties. I love my computer. 1 second.
That's all right.
So while we're waiting though, just a couple of things. One, I want to make sure everybody's aware that effective January 19th, that DACA recipients are now eligible for FHA financing. So I want to make sure you're aware of that. And also on March the 1st, the new format of the 1003 is rolling out. So what that means is that any loan where DU or LPA is run for the first time after March 1st, we will be required to use the new 1003 format for that. Anything that was run prior to that can stay with the old format. So that's a big change for us here. And then also, one question that we get frequently is regarding realtors using their own commission for qualifying and if that is acceptable. And it's different by agency. So Fannie Mae will allow a realtor borrower to use their commission only if the borrower already has sufficient funds to cover the down payment and closing costs. FHA and Freddie will allow you to use it for down payment and closing costs. So anyways, that is a question that comes up a lot, so I just thought that I would share that with you.
Appreciate that, Tracy. And
in the meantime, FHA student loans, they do. You have to document what the fully amortized payment plan is, and yes, you can use the fully amortized payment instead of the 1%.
Cool. Some of those changes come out there. Hey, Claire, with regard to the question about recommend paying the credit card balance more often then so it doesn't get high. Yes, literally had a customer that paid everything great, everything really, really, really low credit score, but paid everything beautifully, great income, great assets, the whole deal. Mortgages paid perfectly, everything else. But because of the credit score, we could not get him done for the client. For the particular product that he was wanting and also for the home. What happened with, I followed up with that client a little bit later, the client actually within 60 days of us not being able to help out and giving him some advice on what to do, actually found out that his hours got cut back at work, actually lost his bonus income. And he called me and said, hey, I'm going to have to just hold off for a while. He actually was filing bankruptcy. So perfect credit history, absolutely perfect credit history. Great job, good assets, the whole deal. Filed bankruptcy. And again, it was because he was maxing out. He was living off of credit card debt so much, paying it well, but just had no thought about, I'm getting $80,000, $90,000 worth of credit card debt built up here. What happens if it's unsecured? So it's like sky's the limit for him. So do keep them. We do advise, try to keep them, paid down. Again, we'll have that 2 weeks from today. That would be a little bit more. Gloria is asking, can a buyer obtain a solid approval loan versus a pre-approval and minimize the time needed to close? A great question. We actually do, I was going to bring it up, we actually do what was called a movement buyer's advantage for self-employed borrowers. Because of all the volume and because of all the advanced changes and really rapid changes out there, we no longer do right now anyway, do the movement buyer's advantage, the pre-approval, full underwriting review without a property unless they're self-employed. That's really where the bigger problems come up. The ones that we struggle with sometimes as lenders are the ones that have self-employed income or are really, you're hearing a lot about variable income because of the way people are paid and some of the guidelines from Fannie, Freddie, and Ginnie, the FHA, the government underwriting guidelines. Tracy mentioned something about the 1003. That is, for those of you who don't know what the 1003 is, there is a new loan application, yippee, that's now more pages, much more in depth that has come out. And that's what she was referencing a while ago with regard to the new 1003. That's the mortgage loan application that we're all familiar with out there. They've made that bigger, broader, perhaps better, but it's just more work on that side of it. So that's what I'm doing. So Sharitha said, to clarify, did Mark say that student loan payments would still be counted as 1% of the total balance for underwriting purposes when in deferment, even if they were on a repayment plan previously?
If they were on a repayment plan, we can document the repayment plan. We can use the repayment plan for Fannie and Freddie. If they are trying to go FHA, we'd have to document the fully amortized payment, or we'd have to use the 1% for FHA.
Gotcha. Thank you so much. And Frida asked, hey, what's a DACA recipient? The 1003 format, that's why I knew that would probably come up. So that's what I would just answer about that. The 1003 is the uniform residential loan application. It's our mortgage application that everyone fills out. That is changing for the industry. Gosh, I don't know how many. I remember back in the day, it was a one-page application way back in the day. Now it's a lot more. So that's what that is. So DU is desktop underwriting. Basically what that is the Fannie Mae automated underwriting system. So we talk about DU. A lot of lenders will use DU. Some will use DU and LP, which is the Freddie Mac underwriting decision. And all it means is there are different agencies. There's Fannie Mae, Freddie Mac, they're out there. There's the Ginnie Mae, which are all the government, FHA, VA, USDA is a whole separate system called GUS. So a lot of stuff that's going on out there, but that's what those are. And those are the automated underwriting systems that we underwrite to without. So basically, if it comes back and says, get this, that's what we're going to have to get. So hopefully that answered that question there. Great questions, gang, that are coming in. So Frida, hopefully that helped you out with regard to that. Tracy, you want to answer the DACA portion?
Yes, the DACA stands for Deferred Action of Childhood Arrivals, which means that these are children of non-permanent resident aliens. So they get citizenship via their parents. And previously, they were not eligible for mortgage financing, but as of January the 19th, FHA is now allowing them to be eligible for financing.
That's a big deal in a lot of our markets, gang. So what other questions? These are great questions. So what other question we have here that we can get answered for everyone here? I think I've got everybody caught up on the chat side. Any situations that have come up or scenarios that you all have had either with us or with another lender that just didn't make sense that you want to ask and say, you know, how could we have avoided that? Or does this sound right? Or whatever that's come up. I know that's happened at some point.
Can you hear me?
Yes.
Okay, I did have a question. Had a buyer, got pre-approved, submitted to offer, and submitted the paperwork to you all. We were like maybe a week from closing, and somehow they dug up stuff that just wasn't quite right for the loan. She didn't do anything different. I need to know, what can I do up front to avoid this hiccup?
Great question. And on a file specific, and by the way, Gloria, if you want to, feel free, email me, contact me directly, and I can get in everything and look at the side of it there. So on a profile basis, that's one of the frustrating things that comes up for you all. It comes up for us because we spend a lot of time on some things as well, and for the loan officer and everyone else involved too. So there are things that come up throughout the process that sometimes conditions you've heard, you may or may not have heard, but sometimes conditions create conditions. But there are other things that pop up just from delay of information that somehow comes through from third parties. With regard to, the specifics, I don't know that one, but I would love to. I'll definitely help you and dive into that. But a lot of times what will happen is when we get things in, we will, from employers, for instance, and Mark Tracy, you can kind of speak to some of the others and everything. One of the things that I know that we have a hard time with sometimes is we'll come up with employers that will have, for some reason, will need to get a written VOE, or we'll do a verbals, because throughout the process near the end, all lenders are required to verbally do another verification of employment. That's even pre-COVID, just to make sure that nothing has changed when they have that. Sometimes when we do so, it could be the people we get a hold of or whatever it may be. All of a sudden, we'll make it just a comment about something that doesn't match up with what we've already looked at. That can all of a sudden cause what would look like a wild goose chase. It's really not. It's just we have to get the details and the facts to make sure that Fannie, Freddie, and Ginnie have a loan that they purchased that is completely accurate. Otherwise, of course, it falls back on us to do that. So it could be that. There's other things that have come up too. We've actually had stuff come up in title that has been exposed. We have some third parties. Every lender has third party providers, for lack of a better term, that will do some background research as well. CoreLogic. There's other things, Tracy, Mark, you can reference if you need to.
Data verify.
That aren't known early on in the process. So it could be numerous different things. It's not often that it happens by any means. It's actually really extremely rare, but it does pop up, and it's frustrating for all. So Mark, Tracy, anything that come up that that maybe into the process you have seen that causes things all of a sudden, well, what we underwrote to now has changed because of this?
Right, so we use a tool called Data Verify, and sometimes what'll happen is undisclosed properties will appear. And so in those cases, we have to go back and ask the borrower if the property's been sold, or maybe they still have the property, and that leads us to ask for additional documentation. Sometimes we'll get bank statements in, and we'll see reoccurring debts on the bank statement, and we'll have to go back and ask our borrowers to provide us with an explanation on what those are. It's possible it's new debt that wasn't on the credit when credit was pulled, or maybe it's just credit that's not reporting to the bureaus. So those are some of the more common things that we see. We may get a bank statement in and there's NSF fees that we need now an LOX on, an explanation from the customer regarding why there are NSFs on their bank statement. Bank statements, a lot of times because we're getting those in to update assets, or maybe to show that their earnest money deposit is cleared, transfer of gift funds, liquidation of 401k. So a lot of times we're getting updated bank statements right before closing. So it's just really important to review those bank statements and see if any additional information is going to be required.
All right, thank you.
Cool. Yeah, Gloria, please. I've got it written down here. I'm gonna follow up with you too, so I can give you more details on specifics and whatever like that for sure. There's another question kind of close that. For VA loans, is there anything special that our realtors can do or prepare for to help with the process on VA loans? To basically ask, I guess, of the clients, or anything that they can do to help prepare on a VA loan.
Mark, you want to take that one?
Yep.
I would just make sure if they're, depending on if they're active duty or not, is truly what's going on there, and just double checking, making sure if their orders on their pay stub show that they're still there for at least a year, because if they're expiring within the year, you've got issues on those. And then just making sure the borrower has a copy of the COE would be a big help as well up front.
Yeah. Certificate of eligibility of the COE on that side. We do a lot. There's a lot of acronyms out there in the mortgage world, but the certificate of eligibility is a key thing on that side of it. Now, our loan officers and our underwriters, of course, we're a huge VA lender. We actually started our first operations office and corporate office was in Virginia Beach. And one of the founders of Movement Mortgage is a decorated vet, and we have a lot of focus on our veterans and want to do what we can to help there. So yeah, the certificate of eligibility, things like that. Our loan officer will know to ask that. Other lenders that maybe, I actually talked to a loan officer last week with another lender, and he just doesn't do VA loans. Just not a big focus for him or the company that he works with. And so those type of things that are out there, it is helpful to help them make sure they do have certificate of eligibility, and are they active, as Mark alluded to, because that is that's really key. And following up on that, Claire asked a good question too. She said, should we ask clients any specific questions before sending them your way? Anything we should screen for? Great question. And not so much asking questions, because our loan officers are coached, and we're going to do that as well, because we don't want to lay a bunch of burden on you all. We want to take that off of you and make sure we run with it hard. But I will tell you this, one thing you can clarify and really hone in on with them is just don't make changes. We, as loan officers, one of the first things we do when we talk to people is like, do not, don't make any new purchases. Don't let anybody, run a credit inquiry at Belk with the perfume, person spraying you, open up a Belk credit card. Don't do anything at all. Don't quit your job. It's amazing how many times we've gotten 3-4 weeks into the process, and we're clear, ready to roll, and we do a verbal verification of employment and find out that the client quit their job 4 days ago, a week ago, whatever like that. So things like that, you can kind of really help us out by encouraging them, please stop everything right now until we get your keys to your house. Then you can start up. Don't buy furniture a week before closing. Things like that pop up. It's crazy what things can happen. So Claire and everyone else on there, that is something I know would be a big help. If you could just help them stay in touch and listen to their loan officer wherever they are. Melissa asked, I know you mentioned this, did you say that a realtor can use her commission to determine eligibility if there's enough money in the bank to cover down payment and closing costs? You want to build on that?
I can clarify that. So if it's your personal loan and you want to use your commission towards closing costs and down payment, FHA and a Freddie Mac, so an LPA loan, will allow you to use your commission in the transaction. Fannie Mae, however, will only allow you to use your commission towards down payment and closing costs if you have sufficient funds of your own verified without those funds.
Help out there. Desiree, everyone saw this. If you're looking at your chat, everyone saw this, but Desiree mentioned on here, speaking of frustrating, and I get it. We hear this all the time. And what Tracy mentioned a while ago, or a lot of times when we get title back, and attorneys are buried right now as well, because they're servicing their clients that are wanting to refi also. So they're buried. And a lot of times we may have an approval done, and all of a sudden we get title and find out, whoa, there's something out there none of us knew about on our client. And she mentioned on here that she had a recent experience that was not with us, thankfully. But anyway, a few weeks from closing, the lender uncovered that the clients had a previous foreclosure from over 9 years ago. It's key to know that a lot of times we've had clients that will say, I haven't had a foreclosure in the past. Now it's 7 years for Fannie Mae. That's different for other VA and FHA and whatever. But for Fannie Mae standpoint, normal conventional loans that we see, it's a 7 year now for foreclosure requirement, moved from 5. But here's the thing. The client answered no, but that foreclosure date doesn't go on when it may have shown up that they went into foreclosure. The actual foreclosure date that may report, and correct me if I'm wrong, Tracy and Mark, but that foreclosure date actually may be a year or two down the road once they finally close everything out and they update it on the court records.
Yeah, it's based on when that deed is filed by the county. So, I mean, just because you started going into that foreclosure doesn't mean it was actually foreclosed on then. I've seen one that happened 4 years later. Like, yeah, here's the proof that I started going into my foreclosure. It actually didn't get filed until 4 years after the fact when the actual deed got filed, which is crazy.
Yeah, that's tough. So That's a great question, and it is something that does come up. And again, it's based on the filing date, as Mark said. Bernadine asked a question: can builders still force buyers to use preferred lenders to get incentives after January 16th? A lot of talk. Actually, to be honest with you, there's been a lot of talk about that for, golly, 15, 20 years, back and forth on that side of it. So let me answer, from that aspect of it, is there are some builders that have their own in-house mortgage company. And they're going to put in some stipulations that say, if you use our lender, and it's either in-house or it could be a preferred lender, and we're on some builders accounts as well. It could be that they will either increase the deposit up front, or they're going to give more closing costs available if you use this particular lender on that side of it. So as far as forcing to get incentives, yes, the January 16th side of it, there's still some debate back and forth on that. So yes, as of right now, they can. Now, it's always frustrating to us when we work with a file. We have customers and clients and buyers and our realtors and the whole deal that we'll go have our client. We've been working for 6 months sometimes to go to a builder that we're not on that list. And they're saying, if you want these incentives, you have to use these lenders or our in-house lender. It's frustrating, I know, as a loan officer. It's frustrating for us also. I do know from a builder perspective, they're turning dirt. Their investment is much, much more intense, and they're building a house based on an approval. And I know the builders that we work with, most of their fallout does not come from the preferred lenders. It comes from the third parties that are out there, a lot of online lenders. So I see their side of it as well. I agree, it's frustrating for all of us, but we will see. I would watch that closely and see what happens over time, because I know that's being battled. It's been battled for 15 years. So we'll see. Catherine, put a thing on there to also said, if anyone interested, we have a do's and don'ts that a lot of our loan officers use for clients. If anyone's interested in getting that list, it basically says do's and don'ts while getting a loan. Some of the things I just mentioned on that side, but we'll be glad to provide that to everyone as well. So just let us know and we'll make sure we get that out to you. Sharitha asks on here, financing investment properties, not lots, or second homes. Are these a preferred product for movement mortgage? Typical down payment and other pertinent items that may differ from primary residences. Mark, number one, anyone buying a home, that's our forte. Okay, so there's not much out there that we don't have as a lender that we focus on, and we want to do what we can on. So investment properties, I will tell you, down payment and even rate is going to be different on those because there's just more risk to them. So with every lender, that's going to be a difference there. But Mark, Tracy, you want to kind of highlight the difference between second and investment, because really primary and secondary, there's not much difference with regard to the underwriting guidelines.
So as far as investment properties, there's going to be a higher down payment for sure. And if there's mortgage insurance, the mortgage insurance premium will be higher. The amount of seller concessions that are allowed, the maximum allowable, is going to be less on an investment property as well. And then you also have the option of using rental income from the subject property or not using rental income from the subject property. And if we are going to use rental income from the subject property and it's a single family, then we are going to require comparable rent schedule when we order the appraisal. But basically, as far as income calculation, credit, and assets, we're going to be treating those the same on an investment property. It really comes down to down payment, seller concessions, and mortgage insurance, and whether or not we're going to be using rental income and cash flowing that rental income.
Well, just to chime in, to investment properties, we can't accept gifts. So if you're doing, if you need gift funds, I mean, investments, you can't go that way. So she said assets, so just chime in there.
Gifts are okay on second homes, right? Cool. Another question here. For small business, does the profit loss statement have to be audited to get loan approval?
It does not. You have the option, you can either submit an audited or an unaudited. If you submit an unaudited P&L, then the agencies require 3 months business bank statements to correspond with the last 3 months on the P&L. And we're going to be looking to make sure that the deposits, the gross receipts that are being deposited into those business bank statements align up with the average gross receipts on that profit and loss statement. If they don't line up, say that they're a lot less, then we may have to come back and ask for some additional documentation to support the current income.
Good info. Did that help answer that question? And by the way, we're recording this. I'll send anyone who wants to email me. We'll make sure we get this recording to you as well, so you can get more details. But anything that you need more info on some of the stuff that we've done, just to kind of pique the interest, maybe another question came up, feel free to email us. Email me directly at david.millsaps@movement.com. We'll get that out to everybody afterwards. We're also going to send the do's and don'ts pretty much to everybody as well, because we got several people that have asked for it. Claire, another great question here. I've had clients who are hesitant about getting a pre-approval from a lender because they don't want their credit score pulled so many times, thinking their score will go down, and they don't want to pay for a pre-approval until they are sure. What should approach these situations, right? Reading that right, Claire? Let me answer that side, because that's going to be more of the credit question. It'll be a great one with Jordan in 2 weeks to kind of cover as well. But I will tell you this: a long time ago, the algorithms on the credit scores, they've been updated through the years. You can tell I've been around a while, and back in the day, we used to underwrite based on scratch pad of paper, and character was a big deal. It's like, you know what? I think we'll go ahead and make this loan. Credit scoring came into place and played a lot of that. Inquiries used to have different values assigned to them with regard to the algorithms going into credit reports. And again, we'll go into more of this detail in 2 weeks with Jordan, but I will tell you this, that we get that all the time. We understand it. On a mortgage inquiry, unless they've changed things recently, mortgage inquiries don't hit as hard. And that changed in the 2007 mess, as my understanding on that. They don't hit as hard as a credit card. Credit card inquiries, installment loan inquiries, things like that, those are going to ding your client hard. So they don't need to go out there and shop to 10 different lenders. They need to kind of narrow that obviously down. But the problem back in the day in 06, 07 realm was a lot of people, it was just, the fangs and talons were out all the time in the lender world, and literally had clients that were told, don't let anybody else pull your credit. But that was typically because it was someone in that time. We had a lot of loan officers out there, and the broker world and everything else was really hot and heavy. And that was a way for them not to shop and find they were getting a really bad deal on rates and points that were charged. That world has calmed down a lot. So you won't see that. That is a great question. They do need to watch that. And the best thing to do is just kind of walk with it. We can tell them what's on there already once we do that, and let them know. We can see, but normally we don't see more than 2 or 3 these days, probably clear from what you just mentioned on that side of it. So that's the case.
And also the credit report's good for 4 months. So once we pull the credit, as long as they close within 4 months, we're not going to be repulling credit. So depending on how actively they're looking, if they're looking to buy a house quickly, once we pull it, as long as they close within those 4 months, you're fine. You're not going to be repulling credit.
Great point. Great point. Bernadine asks also, in new construction, do we need 2 appraisals for a VA buyer? Tracy, Mark, either one of you know?
Yeah, not that I'm aware of. We don't require 2 appraisals for that. No.
I don't think so, but that's a good next week question.
Yeah, it is. We're doing our appraisal thing next week, so they'll know that we do from that aspect of it. Oh, by the way, VA appraisals too, because this is something that I'm sure everyone on here knows, but I've talked to some that don't realize it, and that is that VA appraisers, no lender out there has a list of approved VA appraisers that they can use. When anyone orders a VA appraisal, it goes to the VA appraisal department, the VA local offices, and they assign the appraiser. So that is, I know, a frustrating thing, but there's not a whole lot of room to even call and rush them, because they're not on, every lender has an approval process for appraisers, and they put them on their appraisal list. VA, we work with what they send out, which follows up on a deal here. Says that Craig says, if an appraiser sent out in the home is not complete, is the buyer charged extra for a final appraisal inspection? Yes, we really need help in knowing for sure that if it's new construction or if it's not new construction, but there are repairs that have been talked about during the process. If we go out, the appraiser goes out there and something is not right. We literally had an appraiser go out last week and could not access the house because the lockbox was on the door, but the screen door was closed, but the screen door was locked. He could not get to the lockbox, couldn't reach anyone. So he couldn't do it. He or she have to make another trip out to the house. And right now, as busy as appraisals are, and I really encourage you to be on next week's call, same time, Tuesday, Zoom meeting with our appraisal management company, the head of that, Colin, because he can answer more specifics on that. But they are so busy right now with all the refi craziness going on and even the purchase world. If they go out to the house, they want to get it done then. If they had to go back, they are going to charge another inspection fee. And if it's not complete and they have to go out again, they will charge it again. So we typically disclose a final inspection fee regardless, just because we don't know. And if it doesn't happen, then it comes off for the fees. We would rather tell the customer up front there's a potential and prepare them than all of a sudden last minute trying to hit them with that. So great question on that side.
I did have a question.
Yeah.
Okay, anything we can do to prepare our buyers when they're looking for a condominium or a townhouse that's any different from a regular house?
That is a fantastic question. I'll let Tracy and Mark kind of just describe that thing, but there is a big difference in condo. And a lot of times, well, I'm saying a lot of times over the 20-year history that I've been involved with everything. But there are times when it comes up when we've literally had clients and realtors say, this is a townhome, it's not a condo. Then you find out that when you pull the actual zoning and everything else about the property, it was zoned as a condominium. We had a whole builder complex one time that was zoned initially by the initial builder as a condominium complex. New builder bought it, didn't realize that, somehow didn't get caught in all the background work. Now, every home in that subdivision is deemed a condo. Now, good news is we have a condo department, a condo team. In fact, we're the #1 condo lender in South Carolina, and I think the #1 or #2 condo lender in North Carolina. And the reason is because we have a condo, it's called Condo Express, but our condo department that is set up to help you go after that. Years ago, when FHA or Fannie would approve a condominium complex, they stood on the books and it was just out there and it would renew. That went away years ago. So now, even though someone bought it and got approval on it and financing on it 5 years ago, doesn't mean that condo is eligible for financing today. So our condo team will go jump on that even before, early in the process. So that's a great question, Gloria, and something that if you have a condo, stop, call our loan officers or whoever loan officer you work with and make sure they give you all the documentation that they're going to need to make that where it's not going to get down to the last minute and find out it's not on an approved list somewhere. It's a great question. Let's see. Answer some more of these are coming in. Feel free, if anyone has anything that I've not addressed, to jump on and just speak out while I'm looking at some of these words, some of these questions.
I'll add one more thing to the don'ts as far as things that you can do to help us. One thing that comes up quite frequently is putting personal property in the purchase contract. The agencies state that personal property has to be deducted from the sales price for calculating down payment. And that creates a whole set of issues for us. So outside of appliances, refrigerator, stove, washer, dryer, things that typically will convey, outside of those items, please do not put personal items in a contract, because we're going to come back and ask you to get an addendum and have them removed. So that's just one thing to be aware of that would really help us out.
And that's not a movement overlay, right, Tracy? That's
That is not, that is strictly from the agencies, right? Mm-hmm.
Gotcha. Great questions, gang, and hope you're getting some good answers for it. And if not, and not complete enough, feel free to reach out afterwards. Any other questions at all? We're coming up on about 5 minutes left. I want to make sure we get everything answered that we can. And
one other thing I want to add is I know there's been a lot of rumors out there that USDA is closed during the month of February. That is not correct. USDA is open for business, and they are still closing loans too. So just wanted to mention that.
yeah. Amazing the kind of fake news, as we use that term, from 2020. The fake news that's out there with regard to the financing world. And we feel for you all. I tell you, you all have a tough job, not only with all the changes that have come from COVID, just from different lender overlays that are out there, and you're having to try to figure out, why did this one go through here and not here? So, man, we feel for you. Reach out to us anytime you can, whether it's a movement loan or not. Reach out to us and we'll give you agency guidelines. I can't help if it's an overlay with some other lender. We can't help there. We might be able to explain and shed some light on it, but please reach out to us. But right now, the inventory level, I know it's frustrating to you, and it's frustrating to us. We have a ton of buyers that we have pre-approved from either the automated underwriting system with DU or LP or Jenny Mae with the Gus approval for USDA loans. We have them sitting there, and if it's self-employed, again, those are the ones we can actually put in even without a property under our movement buyer's advantage right now, and take away the biggest, most of the time, the biggest concern is the income actually matching what we pre-approved them on. So we know it's tough out there, and just hang in there. The buyers are coming out of woodwork. Rates are going to remain low, we think, at least this year, maybe next even. So hang in there, because I know it's so frustrating for you to have someone looking for a house and can't find it. So that's good. So Craig had one more question here. I want to follow up on new construction. By the way, the appraiser sent out and the home's not complete. That question on new construction, who you contact for construction status before sending out the appraiser. Every builder has some type of a closing coordinator or someone that's that. Some of them have an appraisal department, like True Homes, which we're one of the preferred lenders for. True Homes has an actual appraisal hotline that is this really ready to go out before we send the appraiser out? So we do contact that person. If you know there's a specific contact too that you rely on and you sell a lot of new homes, please let the loan officer know also, so we can make sure we tell the appraiser, hey, when you go out, before you go out, contact these people as well. Sometimes we'll even do so as well. We're sending an appraiser. We know he's going out on, or she's going out on the 24th. Is the home, in fact, ready and complete when that happens? So great question there. Any other questions at all, please email me. Again, I will send out an email on that, or contact your loan officer directly. They are so much more capable and vested in making sure that we get you the full and right answer. And hang in there, because it's going to be a phenomenal 2021. The buyers are out there, and the millennial buyer segment is, as you all know, the biggest buyer population segment that we've ever had in the industry of mortgages and real estate. So they're out there, and rates are going to remain low. And if you haven't, I know you have, but I was telling my son who's looking right now as well with his new job. If you haven't seen what's happening with the rental rates out there, it's amazing what people are paying for rent. We need to get them out of that situation paying for someone else's front door and get them paying for their own front door. So we need you all to do so, and we're here to help. So you all have a great day. Thank you for your time, and please email us with any other questions that you might have, and we'll follow up. And next week, don't forget, 10 o'clock, another Zoom, Ask the Appraiser. So where you can ask all the questions you want of Colin. He's phenomenal. So thank you all so much, and you all have a great week.